The key takeaway here is that tax planning prior to the sale of your business is far more valuable than tax planning afterwards. The good thing is that there's a lot of levers as a seller that you can pull before you sign the contract. If you do it beforehand, you have a lot of options. If you wait until after the sale is closed, those levers close forever. If we haven't met yet, my name is Kyle Glenn. I'm a certified financial planner and exit planning advisor at my firm, Glenn Financial, and I help business owners who are looking to transition on to their next chapter in life while protecting the business and legacy that they've built. Most business owners I talk to have a plan for their retirement, a tax strategy, and at least an idea of how they want to exit their business. But these are typically 3 separate conversations with 3 separate advisors and 3 separate timelines. And in my opinion, that is the problem, because these are not 3 separate events, they're one. And if you treat them separately, you could be leaving money on the table that you will never get back. So in today's video, I'm going to show you how these 3 things connect, and more importantly, what to do with it. By the end of this video, you will know 3 things. 1, how your taxes play out when you sell your business and why the structure you chose years ago will affect you more than just the price that you're negotiating today. 2, how that price would then impact your retirement plan. And 3, how all of this works together. Here's what most business owners don't think about until it's too late. The contract price that you negotiate today is not going to be the retirement account that you are able to live off of for your next chapter in life. Why? 2 reasons. 1, how the deal is structured, and 2, how your business has been structured. Let's take an example. If you're a C corporation, you will be taxed twice, once at the corporate level and again at your personal level. If you go an asset sale, that could mean 30 to 40 cents on the dollar. If you are a pass-through entity, such as an S corporation, partnership, single member LLC, you will only be taxed at your personal level. That's why the entity structure matters, because how you were structured years ago affects you today. That is not to say that one entity is better than another entity, but you do need to be mindful of it when you go to the negotiating table and when you speak with your retirement planner about how much you expect to have after it is all said and done. Now, let's talk about it from a deal structure. There are typically 2 ways that you can structure a sale of your business. The first is an asset sale. These are the equipment, machinery, the office furniture, your goodwill, the client list. These are the things that your business have of value, the assets. These are typically taxed 2 different ways. Once at your ordinary income for some assets, some at a long-term capital gain rate, more favorable. The other way that you can create a deal structure is through a stock sale. This is when the buyer purchases your stake in the company directly. For you as a seller, this is the cleanest structure because it all gets that capital gain treatment other than some hot assets on your balance sheet. But for the most part, sellers, you really do like those stock sales. Knowing how your deal is structured and how the entity is structured is really going to give you granular data to be able to determine how much will be left after it is all said and done, because it's not about the purchase price, it's about how much is left in your pocket. And because of that, let's talk about what happens when the money lands. Let's say you sell your business for $4 million in an asset-based sale. You get that $4 million check in the bank account deposited, you're squared away, right? Wrong, because April is going to come around, and if you don't do your tax planning on the front end, all of the levers that we're about to talk about will be gone for you. That tax bill, without any additional planning, could be anywhere from $800,000 to over $1 million that is being pulled from that account to Uncle Sam. And that's not just the sale price. That's your retirement. That $1 million, let's say, is something that you could have used to be able to fund your next chapter in life. The good thing is that there's a lot of levers as a seller that you can pull before you sign the contract. If you do it beforehand, you have a lot of options. If you wait until after the sale is closed, those levers close forever. The first one that is probably the most common is called the installment sale. This allows you to spread the income of this sale over a period of time, 5, 7, 10 years. There creates some risks because of this. You need to make sure that the buyer can continue operating the business at the same level you have, but it does allow you to smooth out your tax status over a period of time, ideally keeping you in a lower tax bracket during the sale period. The next is a qualified opportunity zone. This allows you to reinvest those profits and defer capital gains, maybe indefinitely, if you put that money into a qualified opportunity zone. This can be extremely valuable to particular people that want to have that development or real estate side still a part of their retirement plan. The next is charitable tools. I think this is really important for everyone. This could be a donor advised fund or a charitable remainder trust. This allows you to be philanthropic and meet your legacy goals while getting a great upfront tax deduction in those years where you have a higher overall income. Let's say you do a upfront purchase where you're getting that $4 million today as a wire for the sale of your business. What you can do in that tax year is a large charitable deduction to a donor advised fund or a charitable remainder trust, allowing you to take that deduction on the tax return in April while still keeping that money in your overall legacy plans through charitable giving. The next is qualified small business stock exclusions, and this is specifically for you C corporation owners. That's why I say one entity structure is not better than another, but you do need to plan for it. And with the qualified small business stock exclusion, if you go a stock sale as a C corporation owner, you are able to exclude a large percentage of that gain because of this amazing tax opportunity. But you need to be able to work in advance in order to make sure that the sale goes a stock sale rather than an asset sale. And then the final one is pre-sale retirement plan contributions. This is contributions to a defined benefit plan or a 401k plan where you max it out in that year of sale to be able to shelter those dollars from your higher marginal tax rate. Let's say you're traditionally in the 22% tax bracket. The sale of your business is typically going to push you up into a higher tax bracket. So contribute to your 401k or your defined benefit plan and shelter those dollars at an artificially created higher marginal tax rate due to the sale of your business. That can shelter tens of thousands of dollars from current year taxation, take that deferral, and compound it for your retirement plan. The key takeaway here is that tax planning prior to the sale of your business is far more valuable than tax planning afterwards. If 12/31 comes around and that tax year closes, those levers turn off. You are then kind of stuck with whatever happened in that tax year. Plan in advance and you won't be surprised. Okay, let's say the sale is done. The money has landed in your account. You've received the wire. You've exited your business. You sat on the beach in Cabo for 2 weeks. Now you're bored out of your mind. For the last 30 years, the answer has been simple. Let's just go back to work. But now you don't have a job. You sold it. What do you do now? Part of retirement planning isn't just about the income portion, but it's about who you are outside of your business. Can we have an honest, realistic dialogue around that question? Because ultimately, who you are affects your level of happiness in retirement. What should happen instead is that before you receive that wire is that you need to have an intentional deployment plan to know where those dollars are going. Maybe you need 2 years of spending in cash. The remainder can go to pay down debt, to fund your charitable remainder trust or your donor advised fund, to help your kids or your grandkids with their college loans. Or simply, I need this amount of money for this amount of time. How much do I need to generate off of my portfolio to live the lifestyle that me and my wife want to live? That's a real question. That's a real thing that you need to answer for yourself with a financial planner, because that's going to help you when you go to the negotiating table for that contract price. And here's what I do. 3 questions that I use when I speak with a client about the sale of their business or their retirement is 1, how much money do you need and what do you need it to do? Not what you want it to do, but how much does this income need to generate for you to be able to sustain this lifestyle? That is a need, not necessarily a want. The second is, what does your tax picture look like now? If you're a business owner, you've been pulling levers throughout the course of your career. You might have been a W-2 employee of your S corporation, taking depreciation, amortization, doing cost segregation studies. Now those levers are turned off. How does this impact you in retirement as income may be forced upon you from your retirement accounts, from Social Security, from the sale of your business? What do we do now as tools have been reduced? And the final thing that I talk about is what happens to what's left. Do I want to leave a legacy to my kids? Do I want to fund a school project or leave money in a donor advised fund or trust to be able to fund charitable objectives? Do I want a statue or a building named after me? Obviously, whatever you decide to do with your money is your choice, and I'm totally for it. But you need to know what you want to do with it. When you answer those 3 questions and you layer on a tax plan with it, you don't just have a retirement projection, you have a retirement plan. And plans, although they change all the time, can give you some assurance that you know what the next few steps look like. And as things change, the plan can account for that. So let's bring this all together. How your business is structured and how the deal is structured affects how much is taxed. How much is taxed affects how much is left over for your retirement plan. How much is left over for your retirement plan affects everything else. If you change one number, you change all 3. That's why I say this is not 3 separate conversations, but one, because of the integration between all 3, and why this conversation should begin years in advance to give you as much time as needed to plan accordingly. The business owners who feel good walking away from the selling table are the ones that prepared years in advance. Not just the ones that got the biggest check, but know what that check is going to do, both from a tax perspective as well as how it will fund their retirement. All right, 3 things that I want you to walk away with from today. 1, the structure of your business and the sale will impact you significantly. It's worth having that conversation in advance rather than retroactively. 2, tax planning in advance is far more beneficial to you rather than a retroactive, let's figure this out type plan. And 3, the sale of your business is not just a windfall, it's your retirement plan. Your goal, selling your business, is not just to get a large payday, which I hope you do, but it's also to walk away financially whole with a clear strategy in place for what this next chapter looks like. I have specific videos for those. I will link those below, specifically on how to structure a sale or what tax planning looks like for the sale of your business. If you're into this, check those out because I think they'll be very valuable for you. If you found this video helpful and you've seen the picture of how your business structure, your taxes, your retirement plan all are integrated together, please like and subscribe to the channel so you don't miss the follow-up videos related to this topic. If you have any questions or comments, please leave them in the comment section below. I'd love to have an interaction with you. And if you're ready to take this next step, hit the link below, schedule a call with me and my team, and we'll start this conversation and see if we are a good fit for you. Thank you so much for watching this video. I'll see you in the next one.